Hi, this is Alison from Prosperity Capital Advisors, and I want to welcome you to our second quarter 2025 market intel report. I want to speak to you candidly about the recent market volatility and the unsettling headlines we've all been watching. My goal is to provide context, clarity, and confidence so that you feel assured that your advisor and our firm are prepared to guide you through this environment and every environment with discipline and purpose. So let's start with what's driving this volatility: tariffs. In 2025, markets and politics are more interconnected than ever. While we remain neutral and respectful of all political viewpoints, we have to acknowledge that the market was expecting some level of tariff escalation. What shook markets was the scope and suddenness of the announcement, a sweeping, aggressive policy far beyond what investors had priced in. That surprise caused companies to pull back. Many eliminated their forward guidance entirely from earnings calls, saying they simply can't forecast what's next. That uncertainty, not just the tariffs themselves, triggered a major shift in investor sentiment. So, where did that leave us? As of April 8th, here's what we were seeing. A globally diversified portfolio was down around 16% for the year. A 60/40 stock to bond ratio diversified portfolio was down about 10%. The S&P 500, the 500 largest companies in the United States, dropped nearly 19%, and the technology heavy Nasdaq index was down close to 23%. These numbers feel uncomfortable, but they're not unusual. Since the 1950s, the S&P 500 has had a 10% drawdown in 55% of the calendar years. It's experienced a 15% drop in 32% of those years, and a 20% or greater drop 18% of those years. Now, the thing about those market downturns is that we have recovered 100% of the time. This isn't new. It's part of how markets work. Volatility is the price we pay for long-term opportunities to grow wealth. And now let's fast forward to the time we're recording this video. Just this afternoon, President Trump announced a 90-day pause on most tariffs for most countries, while increasing tariffs only on China. The market's reaction? A powerful rebound. The Dow Jones is up over 2,900 points, nearly 8% for the day. The S&P 500 is up almost 9.5%. The Nasdaq is surging almost 12%. Tech names like Apple and Nvidia are up double digits. This is a real-time reminder. Markets can shift in a heartbeat. What felt like a crisis yesterday turned into a massive rally today. This is why we don't make emotional, knee-jerk investment decisions based on short-term noise. Now let's talk about the VIX, or what's often called the fear index of the stock market. It tracks market expectations for volatility. And recently, it's been sitting between 35 and 55, a sign of extreme investor fear. But history tells us that high VIX levels often precede strong market returns. When the VIX is between 25 and 35, the average forward one-year return is positive 10.2%. When the VIX is between 35 and 45, the forward one-year return is positive 25.7%. When it's between 45 and 55, the forward return is positive 32.9%. And when the VIX spikes above 55, the forward average return is 31.7% over the next year, showing a sign that when we experience these very fearful and volatile markets, there tends to be, on average, an asymmetrical risk to the upside. Now, we're not advocating for market timing, but we do believe that times of extreme fear often present opportunity. Staying invested during these periods has historically paid off. And if you're fortunate enough to be in a position where you can save and accumulate, there's value in buying as prices are low. Now, for the past decade, the strong United States market performance has made many investors forget about the value of diversification. But now, when uncertainty strikes, diversification across global equities, bonds, and alternative assets is crucial. In our portfolios, we prioritize thoughtful, prudent diversification, which can help cushion the blow when certain markets or sectors fall harder than others. That balance is what helps protect your plan when the unexpected happens. The market is also grappling with a larger theme: the potential reversal of globalization. Tariffs are just one piece of a broader plan to bring jobs back to the US, stimulate domestic manufacturing, reduce regulation, and cut taxes. It's an ambitious agenda and one that brings uncertainty. But again, as we saw today, markets are hungry for clarity. Even a temporary pause in tariffs was enough to trigger the biggest one-day rally we've seen since 2008. This reinforces our belief: stay patient and focus on your financial plan. Ensure that you have the liquidity and the cash flow to weather the storm. At Prosperity Capital Advisors, we utilize the bucket plan to help ensure that our clients are protected during market turbulence. Your now and soon buckets provide liquidity and stability so that we're not forced to sell long-term investments in a downturn. This gives us the confidence to stay the course in the later bucket where long-term growth opportunities live. By building your plan this way, we've created the flexibility and resilience. You're not just invested, you're strategically positioned. So here's the message I want to leave with you. Although global trade wars are not normal, market down draws are normal. Markets move fast and sometimes violently. Reacting emotionally is often the worst move an investor can make. Your plan is built to weather this. We're here to keep you on track, not just through the highs, but through the storms too. If you have any questions or just want to talk, your advisor is here. We're in this together. Thank you for your continued trust and for being part of Prosperity Capital Advisors.
At the time of delivery and any subsequent publishing, information was deemed reliable, but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.